This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore.
Anyways, this weekend we'll get our great producer, Matt Passy, to maybe let the music play a little bit longer here. But I think the comments on the various places, be it YouTube or on the Rational Reminder website, .ca, of course, you can put comments in there. There's been a lot of comments about the music, and some people really don't like it. Some people love it. Some people have changed their minds and they do like it. We like it. We had to change it. The reality is we had to change it because it was causing problems on YouTube.
Yeah, because of the copyright or something like that. It's also such a small sample of, there are thousands-ish of people that listen to the podcast, and we've had in aggregate, probably 10 comments about the music. So We're drawing these insights for a tiny, tiny sample size.
Assuming those 10 that represent other people, and maybe it's just the people that are passionate about the music, but some people are really passionate about the music. I laugh. Someone said it sounded so typical, or the new music sounded so typical. The other one was so original. It's like the irony is that the other one was just picked out of some music box, digital music box somewhere. I don't even know what we paid for it. We did pay for it. It was all legitimate. But the new one was custom written just for us. It could not be more custom. Anyways, I thought that was funny. I don't know about you, but every week you wonder, where's the content going to come from? And then quickly through the week, it becomes oh my gosh, where do we get all this content? How are we going to fit it all in? Then we end up cutting stuff out. There's endless content for us to talk about. And we got some great guest recommendations. Mind you, we're pretty much booked up for the rest of this year. Next week, Craig Alexander, the chief economist from Deloitte, will be here. Incredible interview. And then 2 weeks after that is Michael Kitsis. So advisors out there, of course, know Michael. He's a excellent financial planner, researcher, consultant, speaker, expert on our industry. Great guy. Great interview coming up. Also want to give a shout out to those who might be interested in watching this on YouTube. We're getting more and more viewership over there, and lots of great engagement in the comments. And the last thing, which will make Lisa's daughters laugh, because I think it's pretty funny. They find it hilarious that we're considering having a merchandise shop, a swag shop. We've had people asking for the sweatshirt I've got on and the water bottle that I use when we record this. So we're looking into getting some sort of swag shop going, hopefully in the next month or so. So if you have interest in that, again, drop us a note in the comments if it's of interest. Might go well, might be a complete flop. I don't know. It'll be a neat experiment to try anyways. And it'll be a fun project for my daughter to run. She wants to run our merch shipping out of her basement.
All 4 items.
Well, maybe not even that much. We'll see. Anything else to add? I kind of dominated the intro here after your lovely intro.
No, that's fine. I always think it's good to reiterate the rationalreminder.ca website is the best place to discuss what we talk about on the episode. So if you want to talk about this episode, it's rationalreminder.ca/podcast/109. And also just the general discussion on the Rational Reminder site. It every time I check, it blows my mind. There's, I'll check maybe once every couple of days, and it's there's 10 new discussion threads that have been started, and people are talking with each other over there, which is unreal. And in terms of the actual data on the website traffic, it's becoming heavily concentrated. It's increasing overall, but becoming increasingly concentrated in the discussion page. So it seems like there are a few people that are active and posting and answering other people's questions, but it seems like there are a lot of other people that are going to visit that discussion page and presumably getting some good insight and information from the conversations that are going on. So I think that's great. I mean, the outcome from when we added that comment section or that comment tool, the outcome has been as good as I would have hoped. So keep it up. And like I said, if you want to discuss this episode, which I'm guessing there's going to be some commentary around the quantitative easing discussion or some questions or whatever. It'd be awesome if we could have most of that on rationalreminder.ca /podcast/109.
Agree. Anything else?
Nope, let's go.
Okay, let's go. We'll let Matt take us over to the episode with this snappy new music.
Welcome to episode 109 of the Rational Reminder podcast.
So the book of the week. Wow, what a book. Another great book. I've been lucking out lately with my book choices, but it's called, and I won't use the profane name, but it's Mind F, Cambridge Analytica and the Plot to Break America by Canadian Christopher Wylie. What an incredible story. So you know the story behind Cambridge Analytica?
Somewhat, yeah.
Anyway, so Christopher Wylie is the whistleblower behind Cambridge Analytica, and he came out after the whole debacle with well, not a debacle in Trump's mind, of course, but he came out to talk about how this confluence of all these events, from data to technology to social media to Russia, Trump. Anyway, so Cambridge Analytica is this British political consulting firm that pulls together all kinds of information and data mining that they actually got from Facebook, if you can believe it. So he worked with researchers at the University of Cambridge to get this information from Facebook. And it's unbelievable the information they're able to get from Facebook in an effort to help Facebook deliver better service to its users. It was unbelievable access to some very private information. And not only would they get your information, they would get all the info of your friends. And the average Facebook user has 162 friends, I believe. And there's actually a Netflix documentary on this, which I started watching a couple nights ago, called The Great Hack. So it's the exact same story. But they talk about in the movie that they had upwards of 5,000 data points per person. It's absolutely wild. So they were able to take this data and learn about people, learn about their tendencies, and then figure out what sorts of information they can shove down this pipe into social media. And now we all know that the name of the game for companies like Facebook is eyeballs, right? Is to get your engagement. Well, the way to get your engagement is to send you stories that you like, that you believe in. Because we're all busy, we're all looking for self-affirming information. And we've talked about this many times. So they shove down these fake stories. People like them, people share them. And there's certain personality traits that did more liking and sharing. So they could put down information that would be appealing to who would vote for Trump. So this was discovered and brought to politics by Steve Bannon. And you remember the episode we had where we interviewed Greg Zuckerman, who wrote the book on Renaissance technologies, right? Well, one of the big names behind them is the one that funded this whole thing. So Robert Mercer was one of the early founders of Renaissance Technologies, a multi-billionaire. So he funded this. Steve Bannon drove it. And Christopher Wylie was part of the data analytics behind this. And it is absolutely wild how this influenced the election. It was like the perfect storm. You've got an audience that fed off this information. You have a platform that needed eyeballs. And you had people that figured out how to manipulate this at a time when you could get access to this information about people. And it worked. It worked like crazy. It just shows you how susceptible we all are to our own wirings, right? Our own psychological wirings to want to read stuff we agree with. It's easier, it's more interesting, and to want to share it. And we get validation when someone else shares it. So it's like this perfect confluence. Anyways, great book. Great book. Guy's from Victoria. I think he's actually similar age to you. So who knows? You may have crossed paths on the coast. And,
don't know. Crazy story. And the documentary is excellent. So I highly recommend it. Recommend them both. So I shared a chart on our notes for this week. Just a simple chart from Bloomberg that I caught on the Twitter feed this week, just showing the simple ratio of the Nasdaq 100 index level divided by the Russell 2000, which is the small cap, US small cap index. So just a simple ratio. And it's amazing. You can see it right now. It is almost as high, the ratio. So the Nasdaq 100, the largely tech stocks divided by the small cap stocks. The ratio right now, price ratio is over 7 times higher, Nasdaq to Russell 2000. And has not been this high since the early 2000s. Not predicting anything. It looks a lot like the the spread between value and growth chart that we talked about a few weeks ago, or even a couple months ago.
I actually thought that's what it was until I looked into it more. No,
Same idea,
really.
really.
It's the same idea, right?
Same idea.
Yeah.
But the point is that this run of large cap growth has been, something. I don't know how else to describe it. It's been something.
And it's causing a lot of people, again, as we mentioned many times, to really question the value premium.
Yeah, question the value. I think there's a lot of FOMO going on where people want to be getting in on the price increases of these large cap, mostly tech stocks.
So we were talking about Tesla last time. It was just you and I. And I looked back I remember we talked about the market cap movements of Tesla. So during the recording, it went up one General Motors, then it went down two General Motors while we were recording.
Yeah. It's crazy.
It was like over $60 billion fall in that hour.
Unreal.
So last news item. This one was recommended to us by a listener. I think it was on the Rational Reminder website. So this is an article from Institutional Investor of July 20th. Crazy story. Interesting story, though. It's a 94-year-old donor who is taking on the $2 billion University of Colorado Foundation over active investing. And the quote is, he's suing the foundation over its investment strategy and so-called abysmal returns. So the individual is Clarence Herbst, who in the past has donated $5 million to his alma mater. And he actually used to chair the investment committee in the early 90s. And what he's proposing is that they should replace the diversified equity portfolio with the Vanguard S&P 500. Now, he's long been known to be an index advocate, but he says that the foundation has underperformed the S&P fund by almost 5.5% from 2010 to 2019. And he said that the performance could have been significantly improved by simply investing in a broad index over the actively managed investments and alternative investments. And he believes that this has cost the foundation $1 billion over the past decade. That's what the plaintiff argues. The quote is, the foundation insisted on irresponsibly and blindly paying Perella Weinberg Partners, who's their manager now, and dozens of other active managers and hedge fund managers tens of millions of dollars per year in advising fees out to underperform relative to the market, is what the complaint.
I honestly think it's a bit of a flimsy complaint, because you can compare a lot of things to the S&P 500 and say, well, it was irresponsible not to invest in that over the last 10 years.
Absolutely. And was there a value bias? Small cap bias in the portfolio? Who knows what the makeup of the portfolio? But the story is more interesting. So I did some poking around. And anyways, the fund used to be only in index funds up until 2003. Then after that became more active. But the chief investment officer who made that change in 2003 left in 2009, then joined Perella Weinberg Partners, which then became the firm that started to manage the investments. Lawsuit accuses, and here's the quote, following the initial contract with Perella Weinberg, the foundation did not negotiate the percentage fees and costs it would pay to Perella Weinberg and other active manager firms engaged by Perella Weinberg to manage the foundation's assets, and it has not done so in the last 10 years. The foundation did an insider, I'm quoting here, insider transaction with Mr. Bittman, who was a former CIO and PWP. Anyways,
okay.
So the foundation, of course, responds. They believe the case is without merit. And we've been looking at these issues in conversation with the plaintiff for years. We believe, and our board believes, that following the plaintiff's demands would be a breach of our fiduciary duty, and it would not be consistent with the best practices of colleges and university endowments across the country. And when you compare their performance to Nakubo, they actually outperform the majority of their peers.
Who all underperformed a 60-40 index.
Hey, I'm just reading you the story.
As we talked about in our last episode about this.
Anyways, another story I found is that this is not the first time that the plaintiff has had an issue with his alma mater. He also took the school out of his will after he was upset with how much funding was going to athletics at the university.
Interesting. This isn't the first time I've seen something somewhat similar to this. There was a report in 2014 from the Maryland Institute of Public Policy, I think was the name. But they did a whole research case on public pension plans in the state of Maryland. And it wasn't a lawsuit, but they were looking at similar issues, like basically just saying how much better off all of the people, all of the pension beneficiaries would be if they had just invested in index funds as opposed to paying all of these billions of dollars in fees to active managers.
It's a ton. Anyways, neat story, and please, listeners, if you have other stories you'd like us to consider, send them through either on YouTube comments.
Ties right into the conversation we had a couple of weeks ago about actually for the last couple of weeks, where we talked about the different institutional pension models and how most of them underperform index funds. And then it also ties into our conversation about private equity and how there may have been opportunity there in the past, but now valuations for private equity are just as high as public equity. So there's no expected premium at all. It all ties together.
So on to the big topic for today.
Yep.
I'm super jazzed about this one. So I want you to set it up. Tell us where you got this idea to dig into this and what's the genesis of it.
I don't have a very good answer, to be honest with you.
Well, it's been bugging you for months.
Well, yeah. How did I land on the topic, though? I don't think I have a good answer. But yes, I mean, I've mentioned it on the podcast a bunch of times over the last couple of months that I've been trying to figure this topic out, which is the quantitative easing topic. So it's something I have been spending a lot of time researching. I think one of the hard parts about it is that it's so it's far enough outside the sphere of what I know well that it wasn't as easy as going and finding a couple of good academic papers and kind of getting the main issues, because I pick up the academic papers on this topic and it's like, okay, there's 50 things I need to understand before I can even read this paper.
You didn't have the same foundation that you have on the investment side.
Not even close. Wow. Not even close.
So and I wouldn't say I have that. Getting it right, even.
What's that?
You must have even worried about getting it right. Like you had this reviewed, right?
Yeah, well, that was the whole issue. Yeah. But anyway, I think I got it to a point where I was comfortable at least talking about it.
Okay, so let's go through this carefully. I'm going to stop you a lot. I've read your notes very carefully, and I want to make sure people understand, because this is really important, and there's a lot of conventional wisdom that you kind of will show us that doesn't necessarily hold water.
Yeah, and some of it came up in episode 106 with Jim Stanford. And some of it came up in an episode that we have coming out next week, 110, with another economist, so you'll hear these issues a couple of times in the next couple of weeks. Well, between episode 106, this episode 109, and episode 110, we touched on these issues a few times. Okay, so the first thing to sort of set the stage for the discussion is that this is about quantitative easing, which is a central bank action, and any central bank action is political inherently, and this is not about that aspect of it. This is not about whether or not central banks should be involved or trying to be involved in the economy. This is just about, from an operational perspective, what is quantitative easing, how does it work, and what are the intended transmission mechanisms?
Right. You're not passing any policy judgments here at all.
I'm not saying whether or not QE is a good idea. I'm not saying whether or not central banks are a good idea. Those are all very politicized issues that I'm not taking a position on at all. So I think the thing that people have been hearing, and this is, actually, to answer your question, this is why I wanted to cover this topic, is so many people respond to what the stock market is doing by saying, well, it's being propped up by the Fed printing money.
The money.
And I think that's a way. Well, I think it's. I don't even know if. Helicopter money is a very specific term in monetary economics, but I don't even know if people think that far. It's like, the stock market's going back up because the Fed is printing an unlimited amount of money.
Yep.
And that seems sensible, sort of. If you don't dig into the issues, seems like an easy way to explain away what's happening, at least. But yeah, anyway, so I kept seeing that in YouTube comments, and that made me want to figure it out. Like, is there actually a relationship there? And I didn't know how to answer the question, what does the money printing even mean? So anyway, to understand what the money printing means, and then to understand how that might be related to the stock market, I think we have to take a big step back and think about what money is in the modern economy and what purpose it actually serves.
So this was your first breakthrough, right? I remember when this kind of hit you, the realization of what money is and how it's created.
Well, yeah. I mean, what money is part of it, and I think it's an important part of the foundation of understanding understanding some of the conclusions that we'll get to in a few minutes. How money is created is an important one, and that was one of the trickiest parts to figure out. Anyway, so at the most basic level, and this part I think people are familiar with, money facilitates the exchange of goods and services. Pretty easy. It serves as a unit of account. So these are the required characteristics of money. Serves as a unit of account. So it provides a standardized way to measure income, wealth, asset prices, and profits. Pretty standard.
Yep.
And it acts as a store of value, which allows people and businesses to store wealth in a convenient form in the short term. All of the money, or most of the money in today's modern capitalist economy, is fiat money. So it's not gold. It's not backed by anything. Fiat means let it be in Latin.
I did not know that till you wrote that.
Yeah. And all fiat means is that the money has no intrinsic value, but it's used in an economy based on government pronouncement. One of the interesting things that I've came across while I was researching this is how do governments, one of the ways that governments can give money value is by making their citizens pay taxes in that currency. Thought that was interesting. It doesn't give it intrinsic value, but one of the reasons one of the ways that governments can enforce the use of money in their economy, of a specific money in their economy, is by having their citizens pay taxes in that currency.
In that currency.
Correct.
That's the key. Interesting.
Yeah, I thought that was interesting too. Now, the stability of money, so paying taxes is, I guess, part of that. But the stability of fiat money comes from the productive capacity of the economy. So like Canada or Japan, like those are truly fundamentally productive economies. And that's one of the places that money's value comes from. The supply of money, which is one of the things that comes up in this whole quantitative easing discussion, and the state's endorsement and protection of its use, which ties back to the idea of requiring taxes to be paid in that currency. Now, if you tie all that together, I think you can summarize money as a social construct that facilitates economic activity.
That is such a great line. Because that's exactly what it is. It is a social construct. It's not backed on by anything.
Which is okay.
The belief the system will keep working.
Ultimately, yeah. And the belief that the economy still has productive capacity and that the government will continue to enforce the use of that currency to facilitate economic activity.
Exactly.
Now, the government, in terms of its involvement, does not create most of the money in the economy. Governments are usually the entity that makes physical currency, so bills, plastic bills, I guess, not paper bills, but bills and coins. Governments are usually responsible for that, but that's a tiny fraction of the money that exists in the economy.
And shrinking, I'm sure.
That's probably true too. Most of the money in the economy comes from private banks making loans to individuals and businesses. The vast majority.
Wow.
Now, every time that a new loan is issued by a bank, and this is pretty obvious, I think, but it creates a loan, which is an asset to the bank and a liability to the customer, and it creates a deposit, which is a liability to the bank and an asset to the customer.
No, when they're making a loan, they're not using the money in the bank to make the loan necessarily.
There is no, and I have this written somewhere in my notes, but there is no reserve requirement. There's no requirement to have money to lend out.
So this is fundamental, because you said making a loan creates new money. I can hear listeners saying, yeah, but they have deposits. They're just lending out those deposits. Not necessarily.
Not at all. You go and open up a bank, okay? Before you've taken in any deposits, you can make loans.
Hence creating money.
Lending is the process that creates money, and it does not require deposits to happen.
That is key to understanding where you're going.
Yes. Yes, it is. Now, that concept that private banks create money out of thin air every single day when they make loans, and banks will always make a loan if they have a creditworthy borrower who's willing to take the loan.
And enough demand for those loans.
Well, that's the creditworthy borrowers. There have to be creditworthy borrowers who are willing to come and borrow from the bank. That is where that is exactly the demand for loans, and that's where money comes from. As long as there are creditworthy borrowers looking to borrow money, banks will print new money out of thin air and stick it in the economy. Now, the banks are competing with each other to create loans, to create money. So that competitive force is always there. The constraint that banks have is not deposits, it's not reserves, it's not having enough cash to lend out or whatever. All that's flawed thinking, and we'll get more into that in a second. But their only constraint is their own ability to remain profitable. They can't go and make a bunch of loans that are too risky, where the borrowers are never going to be able to pay the loans back. Otherwise, they risk going out of business. But as long as they have creditworthy borrowers, they'll make the loan. Regardless of any, I can't hammer it home enough. There is no, literally, this isn't an operational thing. This is a rules thing. Central banks in Canada and the US, the Bank of Canada and the Federal Reserve, do not have reserve requirements. So there is no requirement in either of those central banking systems to hold any amount of money on reserve with the central bank in order to make loans. It's like the example I gave earlier. You could open up a bank, take in no deposits, and make loans.
Right. Now, if those loans default, you're going to go out of business as a bank.
So you've got to be careful with who you're making loans to, which is why the money creation is coming from demand for loans from creditworthy borrowers.
Got it.
Banks aren't just creating money because they feel like it. They're creating money if they think that they're going to make a profit on the lending arrangement, which depends mostly on the customer. So what stems from that is that fractional reserve banking. I kind of just blew that out of the water a second ago by saying that there are no reserve requirements in Canada or the US. So fractional reserve banking and then the money multiplier effect, the idea that banks take in deposits and then lend out a multiple of that, those are fundamentally incorrect. That's not how banking or money work in a modern monetary system. And that's just, I said modern monetary system. That might make people think of MMT, which is not what I'm talking about. This is just like operationally, this is how it is happening and how it works. So the way that all of that can be summarized is that borrowing, and I think Jim Stanford talked about this in episode 106 too, borrowing is the money creating process that allows for saving, and not the other way around. It's not people saving money that allows banks to lend out more money to other people that creates savings. It is banks creating money out of thin air, allowing people to make presumably profitable investments, which allows for saving.
Creates employment, creates income, which leads to saving.
But the money creation is coming from initially borrowing. It's not people coming with their hard-earned savings to the bank and the bank lending those hard-earned savings out to other people.
Exactly.
It's the bank creating money out of thin air, giving it to people who they think will be able to pay it back, plus interest. And that's it. Now, all of the banks, and actually maybe it's important to make a quick distinction. Within this system, there are central banks, so the Bank of Canada in Canada, the Federal Reserve in the US, and whatever other banks around the world. And then there are private banks. So the private banks are the ones interacting with the customers. And then the private banks interact with each other and with the central bank. The central bank does not interact directly with individuals and businesses in most cases. So the private banks, the thing that they need to keep an eye on is not their reserves, because there are no reserve requirements. It's their settlement balances. It's their net flows of money. So if a bank goes out and makes a loan to a customer, and that customer goes and takes their money out of their bank account and goes and buys some equipment from their supplier who banks with a different bank, and that piece is key. The money has now left Bank 1 and gone into Bank 2, which means Bank 1 has a negative settlement balance for the day. They have a net negative flow. Now, all of the banks in the private banking system have to settle their balances at the end of each day through a central clearinghouse. And this is where the central bank is able to influence lending to an extent, because they're the ones that dictate, or at least try to dictate, the rate that banks will lend to each other in the overnight lending market. So if I'm a bank and I have a net negative settlement balance at the end of the day, I'm required to settle that up with either one of the other private banks by borrowing from them in the overnight lending market. Or if I can't do that, the central bank will charge me interest. And likewise, if I have a net positive balance at the end of the day, the central bank will pay me interest.
But all the banks in totality will be net flat.
Yes.
Like all the debits and credits will even out. So does that mean they're charging each entity interest between them normally? Is that what normally happens?
So the Bank of Canada, the way that they transmit their target interest rate is by having a 50 basis point operating band around the interest rate that they want to target. What that ends up meaning is that banks have an incentive to settle their transactions with each other at the end of the day. If they can't, they'll have to settle with the central bank, but they would have been slightly better off by settling with the private banks. So the Bank of Canada talks on their website about how their incentive system ends up working really well, where banks can usually clear everything with each other. In times of stress, like what we're going through now, the central bank is there as the ultimate backstop. So that liquidity, that interbank lending, when that locks up is when the banking system can collapse. And that's happened in the past, and that's why, and again, I'm not trying to get political here, but that's why central banks were created initially, was because the private banking system left to its own devices had a tendency of locking up, where banks would not settle transactions with each other at the end of the day.
So those that may be net positive didn't want to lend back to another bank who was net negative, perhaps, on the day.
So that's the idea, yeah. So the central bank will clear everything. Yeah. So that role that the central bank plays lets them affect the overnight lending rate, and one of the ways that they do that is through these things called open market operations. So as much as there are no reserve requirements, bank reserves are sort of the currency that banks use to settle these overnight payments. So you're not required to hold money in reserve relative to deposits, but banks are still using bank reserves. They have reserve accounts that they use to settle, to close their settlement balances. And the central bank can come in and add or remove liquidity in the, I guess, market for reserves.
Interesting.
So if the central bank wants to affect the overnight lending rate, if they want to increase the overnight lending rate, they can go and buy up bank reserves. And if they want to decrease it, they can go and buy assets in exchange for reserves,
which gives them more cash.
Yeah, or short-term government debt or whatever.
Yeah.
So by affecting the supply of bank reserves, they can affect the overnight lending, the overnight lending rate. So that's a really, yeah.
Do you have any sense of how much clearing goes on every night? Do you have any sense of the magnitude of the dollars?
No, I'm sure it's huge. I know in Canada they go through the large value transfer system. I don't know what the magnitude is.
Okay. I'm
definitely not an expert in this topic. I'm just sharing the research that I've done
so far.
That I think that the information we've collected so far gives me a lot of comfort in not worrying about asset bubbles caused by central banks and not worrying about runaway inflation based on the mechanisms that this operates through. But I'm still definitely not an expert. So anyway, open market operations, which is the central bank transacting with the private banks to affect the overnight lending rate. This is a normal thing. Happens all the time, every day, always. In normal times, in abnormal times, whatever. Open market operations. Now, why would a central bank do this? Why would they engage in open market operations? Why would they set a target interest rate? And again, this gets into the sort of political side of should central banks play a role at all, but that's not what this is about. Why would they do this? To affect the overnight lending rate, which ultimately affects the rate that banks will make loans to their customers at. A lower rate in the overnight lending market means a lower rate that banks will charge their end customers on loans, which theoretically should stimulate the economy. If people are more willing to borrow to invest in profitable stuff, that should kickstart everything.
Monetary policy.
And that's just classic monetary policy, right? Where the central bank will decrease the overnight rate to stimulate things, and they'll increase it if they want to cool things off. One of the really important things about open market operations is that when that's happening, when the bank is buying up short-term government securities, the central bank is buying short-term government securities from the private banks, they're doing that with bank reserves. And they'll create those bank reserves out of thin air in order to purchase the short-term government securities from the private banks. So now we have two different layers of money printing, I guess. Private banks make loans to customers, and when they do that, they print money. When the central bank engages in open market operations, which is a totally normal part of their role in the banking system, they'll create bank reserves out of thin air. Bank reserves aren't money, though. They're money-ish, but they're not the kind of money that you can go and take to the grocery store. Bank reserves are only used between private banks and the central bank. But the net effect whenever the central bank engages in open market operations, the net effect on the private banking system's assets is neutral, because they go and create bank reserves out of thin air, and they use those to purchase short-term government securities from the private banking system. The private banking system loses short-term government securities, which end up on the Federal Reserve or whatever central bank's balance sheet. But the private banking sector gains bank reserves. So the magnitude of assets does not change.
Okay, so I can hear many listeners right now saying, okay, is this what happened lately when the central bank bought up a bunch of ETFs in the US?
Yeah, well, yeah, so sort of. That is an open market operation. And well, that's related to quantitative easing, or it is a part of quantitative easing. So, I mean, I want to drive home the idea that normal open market operations, which are part of the transmission of regular monetary policy, setting the overnight lending rate, that's daily, normal stuff. Quantitative easing is just a special case of open market operations. So the thing that you talked about, Cameron, where the central banks are buying up ETFs, that is part of quantitative easing.
So what's the difference between quantitative easing and just normal course action monetary policy?
The big differences are the magnitude. So in QE, they're purchasing larger amounts of private sector assets, and the type of assets that they're purchasing. In normal open market operations where they're just trying to affect the overnight lending rate, they're just transacting in short-term government debt. So they're using bank reserves to buy short-term government debt. With quantitative easing, they're buying larger amounts of longer-term government debt, corporate debt, asset-backed securities, and in this case, maybe some fixed income ETFs. And the goal is different. So the goal of regular open market operations is to affect the overnight lending rate, short-term interest rates, which won't necessarily affect long-term interest rates. Now, if the central bank's goal is to promote, I think it's like stable prices and low inflation and full employment or something like that. That's their goal. So if the economy is not doing well, they'll reduce interest rates, which is what we've seen. The overnight lending rate, the target overnight rate. And they'll do that or one of the ways they'll do that is by engaging in open market operations. Now, recently, when we had this little coronavirus incident, interest rates were already really low everywhere.
Exactly.
Short-term rates. So when that happens, when the central bank wants to do something that should stimulate the economy, but short-term rates are already at zero or effectively at zero, quantitative easing is one of the other things that they'll use. And its intended effect is to have an impact on longer-term interest rates, which is why they're purchasing longer-term securities, longer-term government debt, corporate debt, asset-backed securities. But it's the same mechanism where the central bank is creating bank reserves out of thin air, and they're using those bank reserves to purchase securities from the private sector. The net effect on the magnitude of the assets that exist in the private sector is zero. It's an asset swap. They're trading bank reserves for other types of securities. So the amount of assets is not affected. What is affected is the composition of assets, and that's the key.
Exactly.
That's the key. By reducing the amount of longer-term government debt and other types of debt assets in the market, the prices of those assets should increase, reducing their yields, making it cheaper for companies to borrow money, as opposed to for overnight lending, where that might affect shorter-term rates. This should be affecting longer-term rates, where if a company wants to do a bond issuance or something like that, or the government wants to borrow more money, this should help more with that. Is the idea. Whether it works or not and actually stimulates the economy, that's a bigger question. But I think the key so far is that when people talk about money printing and quantitative easing being the Fed's money printer propping up the stock market, all that's happening is that the Fed is creating bank reserves out of thin air, which is normal. That's not some crazy thing that they're doing. It happens all the time. They're just doing it at a larger scale. They're taking those bank reserves and they're purchasing assets from the private sector. The private sector is ending up with bank reserves. And actually, there's a point that I haven't mentioned yet that's really important. In both Canada and the US, when banks have excess positive settlement balances, when they have lots of extra reserves sitting on their books, the central bank is paying interest on those excess reserves. So if you have way more reserves than you need to settle up your settlement balance at the end of the day, you're getting interest on those reserves. So in quantitative easing, when they're buying huge amounts of assets, then all of the banks are ending up with excess reserves, but those excess reserves are paying interest. Mm-hmm. So it's really just an asset swap. It's truly an asset swap where the central bank is changing the composition of the private sector's assets without affecting the magnitude of the assets. And they're not injecting money into the economy. They're injecting bank reserves. And they're not creating anything new. They're just swapping bank reserves for other debt assets that already existed in the private sector. So balance sheet of the private sector is not affected. The composition of the private sector's assets are affected. And this thing is really just an asset swap where the central bank is trading bank reserves that they created out of thin air, which is why this is referred to as money printing, for private sector assets.
But you can see how someone could take a little bit of this information and create a narrative different than what reality is.
Yeah. There are a couple theories, like, proper academically studied theories about how quantitative easing might work. And I think the evidence on QE is fairly up in the air in most aspects of its transmission effects and effectiveness in general. But the ways that it theoretically should work, one of them is portfolio balance theory, which I kind of alluded to before. But that's the idea that taking huge amounts of certain types of assets off of the market should affect their prices, which should affect longer term interest rates. And then another one is signaling theory, where when the bank is doing this, they're committing to accommodative monetary policy, And when they're engaging these large scale asset purchases, that signals that they're probably going to continue with accommodative monetary policy for a while. And it's crazy how much psychology plays into this, where it's like just by showing that they're going to continue to keep rates low, that's one of the ways that they can theoretically stimulate economic activity. I think one of the challenges, though, is that if people aren't willing to borrow, lowering rates isn't necessarily going to help. And that's kind of been the experience in Japan, where they've engaged in massive asset purchases like this, and it has not been that great for their economy. Their economy still struggled, I guess, anyway. Now, so that's QE should not lead to inflation because it's taking bank reserves, swapping them for other assets. Bank reserves are not money. Banks aren't taking their bank reserves and buying groceries. So it shouldn't really affect the prices of goods. And it's not really increasing the supply of money. It's increasing the bank reserves that banks hold. But banks don't make loans based on the amount of bank reserves that they have, which is one of the first things we talked about. Banks create money regardless of the reserves that they're holding.
Right.
So the idea that all these bank reserves sitting on the bank's balance sheets are gonna turn into new money, that's just completely flawed. I'm gonna come back to the effect on stock prices, but I want to talk a little bit more about the inflation piece. There's a guy named Cullen Roche who he wrote a book called Pragmatic Capitalism, and he's got a paper. I can't remember what the paper's called, but it's a paper about the modern monetary system. And he when the Fed rolled out QE initially in 2008, he was one of, I don't know how many other people there were, but he was one of the few people, small handful of people, who were saying that QE is not going to be inflationary for the reasons that I just described. But there were a lot of people. There was even a big group of economists that published an open letter to Ben Bernanke at the time, talking about how QE was going to be inflationary. But Cullen Roche was one of the few people that said, like, no, this is not dumping new money literally into the system. It's an asset swap and whatever, all the stuff that I just talked about.
Wow.
And that's what happened. Now, was he right, or was it some coincidence in it? Who knows? But it seems like, based on the outcome, that there was not inflation after the QE that happened. And in the US, same as Japan. So it seems like the description that I just gave, which largely came from Cullen Roche, but also from Jim Stanford's book, it seems like that's accurate, where QE does not cause inflation, at least not directly, or at least not immediately, I guess. And so that concept of reserves not equaling new money in the economy, that's not like a simple, oh yeah, that's obvious. It's something that a lot of people have written a lot about. And it's a relatively small group of people who kind of get it, or at least get this interpretation of it. But there's one paper in 2010 from the Federal Reserve's Finance and Economics Discussion Series. And this paper was titled "Money Reserves and the Transmission of Monetary Policy. Does the Money Multiplier Exist?" So this is tying back that idea of, is there a relationship between reserves and money in the economy? And so in this paper, they said changes in reserves are unrelated to changes in lending, and open market operations do not have a direct impact on lending. We conclude that the textbook treatment of money in the transmission mechanism can be rejected. Specifically, our results indicate that bank loan supply does not respond to changes in monetary policy through a bank lending channel, no matter how we group the banks. So, that right there flies in the face of what most people understand to be the way that banking works. And then there's another one from the Bank of England, who's also been pretty vocal. And I think Jim Stanford mentioned this in our conversation with him too, this paper. So in 2014, they had a bulletin titled "Money Creation in the Modern Economy." And here's a quote from them. They said, "Reserves are an IOU from the central bank to commercial banks. Those banks can use them to make payments to each other, but they cannot lend them out to consumers in the economy who do not hold reserves accounts. When banks make additional loans, they are matched by extra deposits. The amount of reserves does not change. So it's, again, no relationship between reserves and actual money, the money that can be used to buy stuff entering the economy.
So what drives inflation then? Additional demand for borrowing? Which means a stronger economy?
Yeah, well, what drives inflation is a good question. I don't know if I'm
just thinking from a money supply standpoint. So money is created by banks making loans based on the demand for those loans, demand for the money. I'm assuming economy starts picking up, businesses may need more money to develop their companies and expand, right? It's not because the banks have lots of money to give out that's driving inflation or driving demand for the loans. It's companies in the economy that's pulling more from the system will cause inflation.
Correct. Yes. There was another paper from an economist with Standard & Poor's that he wrote, I don't know, around the 2010 mark, I think. But his paper was titled, I think, Banks Cannot and Do Not Lend Out Reserves. And the basis of his paper, I mean, I guess similar to the ones I just mentioned, but the basis of his paper was specifically, with quantitative easing, are all these bank reserves going to lead to excessive lending? And his conclusion is basically what you just said, is that demand for loans comes from demand for loans.
Not supply.
It doesn't come from supply of money. And even if it did, bank reserves don't have any relationship to that. So the other piece that's really important is that when central banks are using this tool, when they're using quantitative easing, it is likely a time when conventional monetary policy, so just affecting the overnight lending rate, is not working. It's not stimulating the economy enough. So they feel the need to engage in quantitative easing to reduce longer-term rates. In that type of situation, I think deflation is going to be a bigger concern than inflation. And I think in our next episode with another economist, Craig Alexander, he had a great quote that was like, yeah, you learn in first year economics, you learn that it's the supply of money that dictates inflation. But then in second year economics, they teach you that's not actually totally true. It has more to do with the velocity of money. Anyway, so that's the same kind of idea here. It's like when QE is happening, deflation is likely a bigger concern, and the central bank always has the ability to unwind their balance sheet, to sell assets back to the private sector to increase the overnight lending rate or longer term interest rates. Now, in terms of the effect on stock prices, we would expect, based on the intended outcome of QE, we would expect a positive impact on asset prices across the board, stocks and bonds. Because you think about the two things that the theories that I mentioned, portfolio balance theory and signaling theory, both of those should be making a more favorable business environment. A more favorable business environment should reduce risk premiums. Reduced risk premiums should increase asset prices.
Yeah, reduce the anxiety of that business owner to go and borrow money for their business.
Correct. That's the simplest way I can explain it, is that you would expect a positive impact on stock prices. And there is quite a bit of empirical work. There was one paper in particular from 2014 that I found titled Evaluating Asset Market Effects of Unconventional Monetary Policy Across Country Comparison. And they used an event study analysis, and they showed that within the sample they were looking at, quantitative easing, a 25 basis point surprise reduction in the 10-year U.S. Treasury yield resulting from quantitative easing results in a 0.7% increase in stock prices. So there is a positive relationship. And I've seen papers similar to this on the Japanese stock market as well. But one of the interesting points about that is that conventional monetary policy tools are much more impactful than unconventional policy tools. So reducing the overnight lending rate has a much bigger impact on stock prices than quantitative easing. So the impact of monetary policy on stock prices is reduced when the overnight rate is already low. And I think they had the same paper looked at the UK where I think there was even no impact on stock prices when the target overnight rate was already at zero. But when it wasn't at zero, reducing that rate had an impact on stock prices. And I've read some other stuff about how markets get used to and start to anticipate quantitative easing, and that can have impacts on asset prices. But I think that the idea that QE is propping up the stock market, or like, irrationally somehow creating a bubble where prices are high just because of central bank actions and only that, I think that's incorrect. I think there are a lot of different transmission channels that central bank actions go through, and they can lead to higher asset prices. But I don't think we can say, quantitative easing is the reason that asset prices have recovered from the coronavirus downturn that we had. So that's kind of it. But then, to sort of sum it up, money is this medium that facilitates economic activity, and that's all it does. It facilitates economic activity. In the short term, it can be a store of wealth. Long term, not so great at that. But at the most basic level, it's this thing that facilitates economic activity. Most of the money that exists in the economy comes from private banks making loans to individuals and businesses. And the demand for those loans from creditworthy borrowers is what dictates the amount of money that exists in the economy. That's key. It's not quantitative easing. It's not excess supply of bank reserves. It is demand for loans. Central banks try to influence demand for loans up or down by affecting the overnight lending rate. And when that rate's already at zero, or effectively at zero, they'll use unconventional monetary policy, which is quantitative easing, to try and affect longer term interest rates, to try and have the same overall effect to stimulate economic activity. And from that, we would expect some positive impact on stock prices, but definitely not enough to prop up the stock market single-handedly. And inflation, you wouldn't reasonably expect inflation solely from quantitative easing, because all it is an asset swap. Central banks pay interest on reserves. They're just another form of short-term government debt. Central bank is swapping short-term government debt for longer-term government debt and corporate debt in order to affect the prices of those assets. Now, all of that is fascinating. And I hope that was interesting to people, because that was like literally months of me feeling like I was beating my face against a wall.
I think it's going to become a very good reference discussion for a lot of people.
I hope so. Now, after I'd finished, or I'd started to feel okay about my understanding of all of this. And then I remembered there was a paper I'd read from FAMA a while ago that at the time when I read it, I didn't really get it. But now that I felt I had a better handle on all this stuff, I thought I'd go and read it again. So FAMA's got this 2013 paper. And in his paper, he basically shows that the Fed does not control short-term interest rates, that the Fed follows the market rate that the market dictates, and the Fed kind of does policy actions following that. Mm-hmm. And then he also cast a lot of uncertainty around whether or not, so pretty much definitely they don't affect short-term rates, and he cast a lot of uncertainty around whether or not they affect long-term rates. So FAMA is basically saying that the market dictates rates and the Fed just kind of follows along. So then it's like, okay, I just feel like I got a grasp of how the central bank interacts with the economy and the stock market. And then FAMA's like, no. They don't affect anything. Okay. Anyway, that's it.
Awesome. That was great. So you good to go on to our planning topic?
Yeah, let's go.
So this is an article and shout out to financial planner Jason Heath. He wrote an article in the Financial Post this week entitled 5 Key Personal Finance Lessons We Should Be Learning from This Crisis. I thought it was nice, clean, good topical items. So perhaps we can go through them quickly and maybe add in our 2 cents. So number one of the things that we should learn is stocks can be volatile. I mean, we all know this. We've all said this many times. Volatility always has a story that goes with it. And you went through painstakingly all the crises back to 1900, back in, I guess it was early April on the podcast. But there's always these stories that make the volatility feel worse. So that was certainly the case this time. And obviously selling at the bottom of the downturn, you would have turned what in hindsight was a temporary loss into a permanent one if you didn't stay invested.
Yeah, I think the psychological risk of selling at the wrong time is big with volatility. I think one of the other big things with volatility is that it can happen any time, and therefore putting money that you need in the short term in stocks is generally not a good idea.
Right.
I did a thing for the Globe and Mail a couple of weeks ago for their stress test podcast. And they had this like sort of case study where they interviewed a person, and I had to answer questions about what I thought about what this person was doing. And this person had their money that they were going to use for a down payment on their house invested in individual stocks. And that money obviously decreased in value when the coronavirus stuff happened, and they were wondering about what they should do. And I, in the interview originally, I said something along the lines of like, they need to recognize that they made a mistake and that they never should have owned stocks to begin with. And I think the producer actually asked me to re-record that piece because I was too harsh. But it's true. Like if you have money that you need in the short term, it probably shouldn't be in stocks. And if stocks lose their value because it happens quickly, that's the nature of volatility. Anyway.
Yeah. Ken French talked about that, right? In the return, you've got the expected return and the unexpected return. The unexpected can be positive or negative. Stuff happens in the near term. Number 2 thing we should learn, debt is dangerous. Even though rates are likely to remain low for the foreseeable future, going back to your prior conversation, the Bank of Canada Governor Tiff Macklem was very clear with Canadians, and I quote here, if you've got a mortgage or if you're considering making a major purchase or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time.
There it is. That's signaling. Signaling right there.
Going on right there. Interesting to think about borrowing costs being low. And now with work from home, you wonder what the impact that will have on suburban housing prices. And I know where I am, just outside of Ottawa, housing prices are surging. Is it the low interest rates? Is it the demand? Is it lack of supply? I don't know, but it will be interesting to look back.
I agree. It'll be fascinating.
And on debt, I mean, you remember the conversation we had with Andrew Hallam back in episode 99, and he talked about the happiness research that goes on. He said there's definitely a linkage found in studies between debt and people's level of misery. Something to keep in mind. Number 3, emergency funds have a purpose. Boy, do emergency funds have a lot of respect now, which I think prior to that, I think over the past couple decades, just in my experience, more and more people have thought of their lines of credit for emergency funds as opposed to actually having cash in the bank, 3 to 6 months of expenses on hand. Well, I think now a lot of people have a lot more respect for a cash buffer.
Yeah. I haven't heard about it actually happening. But Ben Rabideau, who was on the podcast a while ago, he was talking a lot about when all of this stuff was starting, about how he wouldn't be surprised if banks start making people pay back their HELOC, like turning it into a regular debt repayment mortgage type thing.
Right.
Or reducing balances of HELOCs. I don't know if that's actually happened, but he was saying this is a thing that could happen, and it'll happen at the worst time, which is why it's not the best place to draw from for an emergency fund.
The next item that Jason highlighted is don't lose sight of spending. And I think I've heard so many people I know talk about this. Like all of a sudden you get this shock to the system where you stop spending. And I think I may have said this on a prior podcast, but for a couple months after the work from home, I had credit card balances that I haven't seen since I was in university. It was that dramatic.
Like low balances.
Low balances, exactly. Like you're not spending. I mean, we're living this at work as well, where we're not spending nearly as much on travel and all kinds of different items. So spending is going down. Savings rate are at a 20-year high right now in Canada, up to 6.1% in the Q1 of 2020.
Which speaks to the QE stuff, like that, the demand for loans from qualified borrowers is low when savings are high. That guy, I think Ben Rabideau talked about that too. It's I think it's got a name. I can't remember what it is. A savings recession or something like that.
Yeah. And then as things come back, I think it's worth keeping in mind. It's probably a good time to revisit your long-term financial planning goals and say, okay, how much do I need to save to reach those? And be mindful as your debt starts, your spending comes back to normal, and perhaps put yourself on some sort of dollar cost averaging automatic savings plan to make sure you keep up the savings that you need. And the last item he had, which I totally agree with, is prepare for the worst. And Jason says, this crisis is a good reminder that we should all plan for the risk of disability or death. And he's quite unequivocal about it. Any working age Canadian who is not financially independent should have disability insurance to replace their income if they cannot work.
I agree.
May sound obvious, but a lot of people do not have disability insurance. And anybody with financial dependence who is not financially independent should have life insurance. So if you have people depending on you for what you earn while you work, and you're not financially independent, you absolutely have to have life insurance. And lastly, get your wills and powers of attorney done. All very sensible, arguably common sense, but I think it's worth reviewing.
The disability one is huge. I was speaking with someone today, and they mentioned that they were reading a book on personal finance, and one of the things that they found interesting was that the author was saying that the most important planning thing that anybody who's working can do is get disability insurance. And it's true. It's not talked about enough. Everyone gets their heads into, should I hold my bonds in my TFSA or my RRSP? Yep. And people think about life insurance. I think that's an easier one to grasp. But statistically, you're much more likely to become disabled than you are to die prematurely.
And you know what gets me on disability insurance? And those on YouTube can see me grabbing my head. What gets me on disability insurance that you often hear is, oh, it's so expensive. Can't afford it. Think about that for a second. If you can't afford it, how can you afford not to have it?
Yeah.
By definition.
That's a good point. I got it when I started with a proper job. I got a policy with I can't remember what it's called, the ability to increase the amount.
The FIO, future increase option?
Yeah. And I've been
income option.
Jacking that up as much as I can ever since.
So on to the last topic.
Yep.
Not necessarily bad advice of the week, but it's a story about the industry that I thought was interesting. And it's something that I really want you and I to dig into more to understand. And we kind of started it a couple of weeks ago with the pay for order flow discussion. I still want to understand how platforms make money, because I think it needs some digging into, because it's not as transparent as I've been able to solve, but we're kind of picking away at it to understand how these fee-free trading platforms actually make money, because everyone knows that businesses are in the business of making money. And this one is an article that came from an industry publication called Advisor Hub, published on June 22nd of this year. The title was Wells Fargo Raises Some Revenue Sharing Fees for Asset Managers. So basically it comes down to this. And I did some research with I looked into some research done by a friend and an upcoming guest, actually, Michael Kitsis, who talks about how mutual funds in this paper that he wrote, and I'll get back to the Wells Fargo article in a second, but I want to set it up. So he pointed out that mutual funds have been trading for free. So these are mutual funds, not ETFs, trading for free on no transaction fee platforms for a long time, like going on 30 years. And this was enabled because in the US, they've got what's called 12B1 shareholder service fees that were charged instead of charging transaction fees. The problem is that ETFs don't have these kinds of fees. So they need another model in order to be able to keep everyone happy, to raise fees so that platforms could trade for free. So what came out of this is platforms, so the big brokerage platforms, negotiating with the providers for shelf space fees. And they could either be flat fees or basis point fees. So this is the area I want to do some more research into and understand more about this, but I just want to raise the topic this week. But get this, Vanguard has never paid shelf space fees, but many of these platforms allowed Vanguard onto their platform to get their credibility.
Wow.
These are the Vanguard mutual funds. So let's go back to the article now. So Wells Fargo, the point of this article is that Wells Fargo has raised the upper limit of these fees that third-party asset managers, so pick a mutual fund manager, pays Wells Fargo to get access to brokers who sell the mutual funds and ETFs. So sometimes these are called data agreements, but get this, a minimum at Wells Fargo the minimum remains at $450,000 US to get access, but the upper band has moved from $650K from $550K. Is that a lot of money? I don't know. I don't know what it is in terms of basis points overall, but the point of the article is that there's a pretty good chunk of change being paid just for access. But apparently it's lowered other record-keeping fees and other admin fees a few basis points. Anyways, the point of the article is that these fees are a pretty important source of revenue for large brokerage firms, but they make the argument that it's a big barrier for smaller asset managers because they may not have the asset base to amortize those fees over. Article also mentions that Morgan Stanley charges as much as $600,000 a year for allowing fund salespeople to market to advisors at branch offices and conferences. And like Wells Fargo, Morgan Stanley charges a platform fee of between 1 and 10 basis points of assets per year. They go out of their way to say, however, if you're in a fee-based account, some of that's reimbursed. So again, we have to understand more. The point is there's a pay-to-play game going on here that had to change when fees, the 12B1 fees were charged to mutual funds and shared with the platforms. They're not part of the ETF world. Found another article. Let's see here. Morgan Stanley a couple of years ago received a negative press when it stopped selling Vanguard mutual funds because Vanguard refused to pay for shelf space.
Crazy.
But you can't keep people from trading in ETFs. So I guess you could still buy a Vanguard ETF through Morgan Stanley, but there is no pay-to-play fee in there. So you can't close off access to ETFs, which you can do to mutual funds. How does the money get around to afford these platforms? I don't know the answer. That's what we have to learn more about. Anyways, the reason that Morgan Stanley gave for stopping to sell Vanguard mutual funds is that it's cutting its shelf space by 25%, and they attributed the drop to the fact that Vanguard attributed the drop to the fact that they may maintain low cost by not paying shelf space fees. Morgan Stanley said they were being dropped due to underperformance. So you can see kind of both sides of the debate going on here. Bottom line,
Crazy.
We have to learn more about this, but there is some level of conflict of interest going on here. And bottom line is that nothing is for free. Anything else to add?
Nope.
For those watching online, you'll see that Ben's video stopped here, but we got his audio. Anyways, thanks for listening. If you're there, Ben, you can say goodbye.
I'm still here. Just my video seems to be having some problems.
All right. Well, thanks for joining us.